All right, let's get right into it. Supermicro's latest earnings just hit the street, and wow, this is probably one of the most polarizing reports we've seen in a long, long time. So let's break down exactly what you, as an investor, need to be thinking about.
So here it is, the whole story in a nutshell. A big miss on the quarter, followed by an absolutely massive forecast for the future. That's the trade-off. That's the dilemma every single person looking at this stock is trying to figure out right now. Okay, so let's start where Wall Street always starts, the headline numbers. And, this quarter, they really weren't pretty.
So check this out. Supermicro's Q1 revenue came in at just a hair over $5 billion. The problem? The street was looking for $5.8 billion. Now, in any market, that's a miss, but in the AI space, where everyone is just obsessed with growth, an $800 million miss, yeah, that's going to raise some serious red flags. But, and this is a big but, the story behind why they missed is, well, it's everything.
Now, management didn't waste any time explaining this one. CEO Charles Leong came out and said, listen, this wasn't us losing business. What happened was a shift, a $1.5 billion shift from this quarter to the next. And why? Apparently, some of their biggest customers came in at the last minute and wanted to upgrade their orders to even bigger, more complex systems. So the bull case here is pretty clear, right? This isn't a loss, it's actually just a delay for an even bigger payday. And that explanation tees up the other side of this story perfectly. The guidance. Because this, right here, is where the whole narrative just flips on its head. We go from a pretty disappointing quarter to a future that looks, frankly, explosive. Just look at this number. The company told us they are sitting on a backlog of over $13 billion in orders for their new NVIDIA Blackwell systems. I mean, think about that. That is a staggering figure. It just screams that the demand for their AI gear is absolutely relentless. And all those back orders, they're what's fueling this next number. Supermicro jacked up its full-year guidance for fiscal 2026 to, get this, at least $36 billion. Let that sink in. They just did a $5 billion quarter. To get to $36 billion means they are forecasting a massive, massive acceleration for the rest of the year. And here's the CEO, Charles Liang, again, basically doubling down on that confidence. The message they're sending couldn't be clearer. Hey, forget about that little timing issue in Q1. The big picture here is growth like we've never seen before. He calls it a truly unique time, and you know what? A $36 billion number, that's the kind of thing that makes even the most skeptical analyst on Wall Street sit up straight and pay attention. So the big question is, how on earth does a company plan to grow that fast? I mean, we're talking about almost tripling their current run rate. Well, it all comes down to the strategy they keep talking about called DCBS. And yeah, let's go ahead and figure out what that alphabet soup actually means. Okay, so DCBS. It stands for Data Center Building Block Solutions. What does that mean in plain English? Think of it this way. Instead of just selling you the parts, the engine, the transmission, they're now delivering the entire fully built, ready-to-go Formula One car right to the racetrack. It's a huge leap up in terms of what they're selling. And this chart here really shows you that evolution. They are literally climbing up the value chain. It started with just selling servers and storage, right? Then they moved to putting those into fully integrated racks. Then they started selling entire AI clusters. And now they're at the top. The whole shebang, the complete data center infrastructure. We're talking everything, including stuff like liquid cooling. Every step up that ladder is a bigger, more valuable sale. But, and you knew there was a but coming, this kind of insane hyperspeed growth, it doesn't come for free. And this right here, this is the part of the earnings call that really made investors a little nervous. There is a very real, very significant short-term price to pay for all this growth. This slide lays out the deal perfectly. It's the bargain that Supermicro is basically offering to every investor. The reward? An insane revenue number and a chance to grab massive market share. But the cost? Well, that's near-term profits getting squeezed, a ton of risk that they can even pull off these huge new deals, and a constant need for more and more cash just to keep the engine running. So let's put a number on that cost. In Q1, their non-GAAP gross margin was 9.5%. Now, that's already a bit thin, maybe lower than a lot of people wanted to see, but that wasn't the real bomb they dropped. The real shocker was what they said about the next quarter. Yeah,
This is the quote that sent a jolt through the stock. The CFO, David Wygand, comes on and says they expect gross margins to drop by 300 basis points. For anyone not in finance, that's 3 full percentage points. So take that 9.5% we just saw and subtract 3. You're talking about a gross margin down in the mid-sixes. And for a hardware company, wow, that is razor thin. So what's the excuse? Well, management says this is all strategic. It's an investment. They're saying, look, we took on a huge new deal with a really important customer, but we had to give them a lower margin to win it. We're dealing with the startup costs of this brand new super complex GB300 platform, and we're pouring money into building out our factories all over the world. It's the classic, you gotta spend money to make money play.
Okay, so let's tie all of this together. What's the bottom line for you, the investor, trying to decide what to do with SMCI right now?
It really just comes down to this simple table. You have two completely different stories fighting it out. The bulls, they're looking at the future. They see that jaw-dropping $36 billion forecast. They see the $13 billion order book, and they're buying in. The bears, they're looking at right now. They see the big Q1 miss, they see the margins getting crushed, and they see the massive risk in trying to grow this fast without something breaking.
And so that leaves us all with the ultimate question, doesn't it? Supermicro has made its choice crystal clear. They're sacrificing profits today to go after what they believe is a once-in-a-generation shot at dominating the AI infrastructure market. So, is that a brilliant long-term strategic move, or is it a super risky gamble that could blow up in their face? That's the billion-dollar question you, as an investor, have to answer for yourself.